Morning. Chris, yes, morning. Well, I was here last week, but clearly you weren't. But no, had a couple of, my wife had been a bit poorly and stuff like that. So there we go. Anyway, I'm 65 now, as of yesterday. 65 years old. Incredible. I never thought I'd get to this sort of crinkly age. Yeah, morning to you, Peter. Morning to you, David. Mia, John. Good to have you on board. Yeah, interesting week. Yeah, tough week for the markets. A lot of things going on. Sterling all over the place. Weak. Morning to you, Gary. Michael, that's still a young man. Thank you. Of course, in my head I am. That's when you look in the mirror that you find out you're not. And Japanese yen, an election looming in Japan. They've got a new prime minister who called a snap election. Seems to be the way of it recently. Yeah. Morning to you, Paul. And Capital, we've got this not fear of an escalating war in the Middle East. It has escalated. And this escalating war in the Middle East, that's really putting pressure on stock markets. And you finally have oil jumping sharply, partly or largely down to comments that President Biden made when he said that Israel could engage in military strikes against Iran's oil industry, which I thought was a bit of an own goal, really. Why would he want to have oil jump 5% on the back of his remarks at a time when he really wants his central bank to beat inflation? Anyway, he did row back on those remarks, quite interesting, and said that he's told Israel not to attack Iran's nuclear industry or oil infrastructure. Anyway, then we had non-farm payroll came to the rescue. Yeah, let me just remove the minor ones, clog the screen up with stuff that I don't want to talk about. Yeah, it'd be good if we could actually get to the point. Week. There you go, non-farm employment change. Wow, look at that. So on the week, it may not sound that impressive. The FTSE was sort of unchanged, up 12 points. The DAX actually down a couple of hundred. German data still not particularly good. The Dow was 13 points up. That's virtually nothing. S&P up 8. That's virtually nothing. So unchanged, really. NASDAQ up 18. As a percentage, it's like 0.08%. The big moves yesterday or last week, I should say, Japan. Look at Japan. That's all down to the weakening Japanese yen, which has come about with this new prime minister who rather naively implied that he would pressure the Bank of Japan not to raise rates. Wow. How naive is he ahead of an election? That's not what you're supposed to say. And then, so the Nikkei up, gosh, 2,000 odd points last week, because that's where we closed on Friday, and then up we went. Yeah, extraordinary. Well, that was down to the fact that an election, a snap election, had been called. And then Hang Seng, Hong Kong, China, markets going ballistic. Really interesting article in the FT that reminded their readers that the crowd is so important. It's difficult to justify this sort of move on the back of what the Beijing administration announced and the support for the markets from the PBOC, the People's Bank of China. But look at it, it just keeps going. Extraordinary. Yeah. Anyway, from my numbers, my number crunching, we talked about it last Monday, and the Nikkei was up 15% the previous week. By the close of last Friday, Hong Kong's Hang Seng was up another 8.5%, and it now leaves the Hang Seng up 30% for the year. I mean, not surprising when you look at it. It just looks even more dramatic when you scrunch the chart up and go back to the beginning of the year, but way higher than the start of the year, and actually has made it the best performing stock market this year when it was one of the worst. Yeah, wow, the power of the crowd, just that. Anyway, we are weary. or wary, I should say, of this war in the Middle East and the effects it could have on growth. Remember that the Middle East is an important trade route for commerce. We know that the Houthis have put a lot of shipping off from taking the route past Yemen and are now going around the Horn of Africa. It's complicated. And obviously oil production, if that is affected in any way, that'll have a dramatic impact on business and economic growth. Be good for oil producers, not good for consumers and business. Anyway, it was the data that came out last week that really put the cat amongst the pigeons, and it was the ISM services data that I couldn't, but I thought it was a misprint. 54.9 after 51.7. I mean, it is really, really strong data. It almost looks too good, actually, at 54.9, and that's the highest level it's reached since March 23. But then the mood was further bolstered last Friday with a non-farm employment change. It's like, are these economists, do they know? Have they got any idea what the data is expected to be? Because we talk about the consensus, the forecast, and that's done by polling various economists and analysts as to what they think the data will be. It's just so far off bad. It's extraordinary. Maybe we'll get a revision next week, but this 254,000 was so much more than 147 expected, and they revised the previous data. So the data for August that was released in September, that was revised to up to 159,000 new jobs for 142. Really, really strong data. And I hear you thinking, well, why is that important? If you remember the fact that the employment market could have been slowing a month and a half ago, the markets were wondering whether the US would enter a recession. So it's extraordinary how this thing has turned around. Or now we've got an economy that's unlikely to have another half a point cut. In fact, it definitely isn't, according to Jay Powell. And I didn't think there would be anyway. But if you look at expectations now, so having a look at the CME Fed Watch tool. Oh, come on, let's have you. So currently rates are at 4.75 to 5, so that's the band that they run in. There's a 93.1% probability of rates being cut to 4.5 to 4.75 at the next meeting on the 7th of November. That's a half point. That's a quarter point cut, yeah. But if you look at this chart down below, a week ago there was a 34% probability of a cut to 4.25. And had you looked at this yesterday, there was a 53% probability. So you can see that the market has really rode back on big rate cuts. That's because the market is performing a lot better. Peer beating rally from Bloomberg. Peer beating rally. Ooh, I'm not sure what you've typed up there. Is that a link, Michael? Yeah. Anyway, the data has been strong. Excuse me. The employment rate, excuse me, 4.1% from 4.2%. Average hourly earnings as well up. So yes, it's probably better news for the Fed. Normally this would look a little bit inflationary, but I think the market's relieved that the US economy is not cooling as rapidly as some had thought, because some had thought, we could enter a recession, a mild recession in the US. That's clearly not going to happen. Ah, okay. Thank you, Michael. Yeah. But it means that interest rates will be cut, but by the year end, so if I look on the 18th of December, there's two more meetings, one on the 18th of December and one on the 7th of November. It looks like we're going to have another quarter point cut in November, another quarter point cut in December. And that, folks, is one of the reasons why the dollar has rallied. it's not just down to interest rate differentials. Why would the dollar rally? If interest rates aren't going to be cut as much, you're going to get a better return in US dollars by leaving your money in cash than you would have done had rates been cut all the way down to 4% or even below. And it looks like rates going to be cut again in the Eurozone as well. So that's sort of countering all of that. It's just interesting the way that the mood seems to shift quite rapidly, which I find quite surprising. Anyway, what else is going on? Yeah, we've got the Chinese market. Well, I've sort of referred to that. That's the big move. I mean, I haven't got the CSI here, the CSI 300, but this is the Hang Seng. I mean, that is the real star performer. And you know, it actually follows on from this announcement by the Beijing administration to stimulate the economy before Golden Week, which was not last week, the week before, which was oh no, hang on, it was last week, wasn't it? Yeah, Golden Week was last week, but before Golden Week, the market had already taken off following this announcement. Golden Week, most of China was closed last week from Tuesday until Friday. And I just found it interesting that the Hang Seng or Hong Kong, which doesn't close for the whole week, it only closed on Tuesday, but for Wednesday, Thursday, Friday, it just went for it. Extraordinary. And it is, as the FT said, the power of the crowd, for sure. Anyway, what else is going on? Let's look at currencies. First of all, sterling, quite weak. And that's down to Andrew Bailey, who suggested rates could be cut more aggressively if the data remain consistent with inflation, heading towards their target of 2%. Yeah, markets where businesses would like to see that. But curiously, the chief economist at the Bank of England, a chap called Hugh Pill, that's P-I-L-L, and Hugh, H-U-W, the Bank of England economist, he basically countered those remarks by saying that rates would need to be cut cautiously. I sort of find it quite interesting. He deliberately came out to say that to contradict Andrew Bailey, it seemed, anyway. Anyway, clearly not in total agreement, but sterling remains a couple of cents weaker as a result of those comments last week. Japanese yen, I've sort of partly mentioned it, but very volatile. Some of these moves, I mean, that move there on the 2nd, what was that, on Wednesday? 143 to 140, that's the yen almost collapsing. That's a big move. And it's down to this new Prime Minister, a chap called Shigeru Ishiba, and his comments midweek when he said that the Japanese economy was not in an environment for further interest rate increases, which is really weird. It's just not something he should be saying, and I think it was a little bit naive. Anyway, markets jumped on the remarks, which you've seen here. The Japanese yen went up against the dollar. Sorry, the number of yen to the dollar went up, but that is the Japanese yen weakening. That is the dollar strengthening. Yeah. And that's a big move, 3 yen on Wednesday, absolutely huge. And we've got this election now scheduled for the 27th of October in Japan, a year earlier than expected. There you go. And clearly we're going to be expecting more volatility in the run up to this election, you know, when this campaigning gets into full swing, you know, ahead of that vote on the 27th. So expect more. You have been advised, or warned, I should say. And the dollar, well, really the dollar on the back of really, when you look at the US dollar index here, that says it all. There's been a flight to quality because of the escalating war in the Middle East that definitely is escalating. We're not fearing it, it's happening. And there is a bit of a flight to quality where investors buy the dollar as a safe haven. And that's partly explains the strength in the dollar, but also that those interest rate differentials where we've seen a reduction in expectation of aggressive rate cuts from the Federal Reserve. So remember, if rates remain higher than market was expecting, that's good for the currency, typically. Oil, well, yeah, it's we know what's going on there. Um, its biggest weekly gain since January 2023. So, that's all down to what's happening in the Middle East with the war escalating. We all feared it, and it's come to pass. And it's Israel, as we know, last week expanded its campaign against Hezbollah with this ground offensive in southern Lebanon and some very intensive bombing of Hezbollah infrastructure in Beirut. I just, I, I just think it seems like Israel are making up their own rules rather than listening to Biden and the Biden's administration. I think Netanyahu has realized that his popularity has increased the more aggressive he's been against Israel's foes. Gold, yeah, gold sort of gets buffeted by, the positives are the escalating war in the Middle East. It's a hell of a global macro event that attracts gold buyers, but at the same time, the stronger dollar will be countering that effect, and that's one of the reasons why gold sort of tracked sideways last week. Okay, any questions about the markets? Anything before I get onto the calendar? I mean, fundamental questions, not technical. We've done all that with Stuart. Okay. Calendar this week, starting the right week, which is not last week. Okay, there we go. Yeah, pretty light calendar, unfortunately. Well, fortunately, unfortunately. We don't have a busy schedule of data every week, but of course, just remember the war in the Middle East is a very unknown event happening. It's very fluid, and obviously, we know that at some stage Israel is going to have make some sort of counter attack or retaliation against Iran for the missiles that were fired in its direction last Tuesday. So that's something that can happen anytime. We can't plan for it, but just understand that can happen. But there's little key data out. I'd say the highlight this week is probably the release of the FOMC minutes on Wednesday. We've also got a bit of data out ourselves, the monetary policy hearings at the Treasury Select Committee. So that will be interesting. And we've also got US inflation. So yeah, maybe a little bit to talk about. Monday, nothing today really. Tuesday, we've got a selection of FOMC members speaking. That's the Federal Open Market Committee. When they talk at various events, it can be interesting. They can not let slip, but they can let the market know, let us know what their view is on rates and what the committee is thinking. And sometimes it can be illuminating. There's a chap called Raphael Bostic speaking about the economic outlook and monetary policy in Atlanta on Tuesday evening. So that's actually quite relevant. That's probably the most relevant one. But that's all Tuesday. Wednesday, we have a monetary policy decision by the Reserve Bank of New Zealand, RBNZ. Yes, that is right. They're going to be cutting rates by 50 basis points or 0.5%. And the swaps market, yeah, it's sort of implying a 75% probability. So the New Zealand dollar pairs will be very sensitive to that news on early Wednesday, if you're around Wednesday at 2 o'clock in the morning. And then the really interesting one as far as the markets are concerned in the US are the minutes from the FOMC meeting held on the 17th and 18th of September. Curiously, here in the UK and in the European Central Bank, they release the minutes from the meeting the same day. I'm just not altogether sure why there's a delay of a couple of weeks, but that always happens with the FOMC minutes. And the prospects, obviously, for this half-point cut have all but disappeared now. So I sort of expect few surprises on the downside, really, but the dollar will be sensitive to those minutes that are released at 7 o'clock on Wednesday, and also dollar assets, so equity markets and bond markets. Then Thursday, we've got that monetary policy hearing. So this is where Andrew Bailey, the governor of the Bank of England, and some other members of the Monetary Policy Committee testify to the Treasury Select Committee at Parliament in the UK, and they're testifying about inflation and the outlook for the economy in the UK. So sterling will be sensitive to those hearings, but they don't actually happen at a particular time, but it happens during the day. US, so then we jump to inflation data. Yeah, this is an important release, actually, probably equally important with alongside the FOMC minutes. But headline and core CPI data, CPI Consumer Price Index, that's inflation to you and me. The CPI is expected month on month at plus 0.2%. Sorry, the core CPI is plus 0.2%, with the headline expected at plus 0.1%, which gives the headline annual rate at 2.3%, inching towards the Fed's target. We had a bit of a blip a few months ago where inflation went up, but inflation definitely seems to be on the downward path. As long as oil does not go up to $90 to $100 a barrel, that would be a disaster. That would really fuel inflation for sure. Yeah, dollar and dollar assets again will be sensitive to the CPI release. Then Friday, monthly GDP data, not so important really. It makes up the quarterly data, which tends to be a smoother report. You can get volatile monthly data reports, and they're always being updated and changed. But we're expecting plus 0.2% GDP increase in. This is for August, so it's also quite backward looking. And then PPI, this is another measure of price changes, but this is to do with the costs of goods and services going into production. So it's called the Producer Price Index, or sometimes referred to as factory gate prices. And it's like a leading indicator to future inflation, but the core is expected at plus 0.2%, which is fairly benign. And the headline's expected at plus 0.1%, which is even more benign. So yeah, nothing too much in the pipeline for inflation as yet. And the dollar, it'd be a little bit sensitive to it, but only if it really misses the mark by a long way. And then prelim University of Michigan consumer sentiment. Gosh, I forgot about that actually. That I always find it interesting the way that Forex Factory categorize these reports. I think this is quite an important release actually, because it's a great way of gauging how confident and how happy the consumer are. And if the consumers are happy, they spend. And if they spend, companies do well. If companies do well, stock markets go up and everyone's happy. Yeah. Anyway, we're expecting a reading at 70.5, so inching higher. That one comes out. So that's the last data released really on Friday at 3 o'clock that we're interested in. That's it. It's quite late. I do apologize. 9:30. Stuart, you had a very busy session, but I've tried to pack it in. Not many questions, but I guess I needed to rattle through it, didn't I? Yeah, Chris, you have a great week. Michael, good week. Paul, all of you have a good rest of the week, and we'll catch up again next Monday. Yeah. Okay. Bye for now.